Welcome to Wealth Unfiltered, your go-to source for industry insights and wealth creation. Stay ahead of the curve with a thorough breakdown of market trends, financial developments, and the impact of current events on your wealth building strategy. We deliver the latest updates and essential insights into the financial world through expert interviews and detailed analysis. Hey everybody, welcome back to Wealth Unfiltered. I'm Samantha Parinello and I am your host. I have our resident guest expert with us, Chris Parinello, so welcome back to the show.
Thank you. Happy to be here.
Awesome. I'm really excited because this episode is all about today's financial landscape. And what we mean by that is there is a lot of uncertainty out there. We've had recent podcasts with Spencer Levy, we had John Chang, and these are well-known economists who point blank will say, we have projections, we're looking at things, but we really don't know what to expect. And I think that that is something that we're seeing on every resource, all across news stations, reports coming out, and there's a lot of uncertainty. And the uncertainty is leading us, Chris and I especially in our household, to really evaluate how we're going to plan for our future. And we need to know all the upside, the opportunity, as well as all the risks coming, and how do we plan for that? So we thought on this episode, we would talk about all of the things that people are asking. Questions that are the jobs market reports, are they accurate? What's going to happen with these pending Trump tariffs, and will they affect the U.S. economy? And of course they will, but how? And, we're talking about all things that have to do with how do we make these financial decisions for ourselves. So I think before we can talk about what we're seeing right now and how we are going to plan for those things, we need to talk about how did we get here? Like, how are we here? And is there going to be a recession? What are we seeing? So let's talk about that first. How do you think? I think everyone knows, but let's dive into the factors, the contributing things that got us to where we are right now today.
Yeah, and I think what everyone should be looking at, and sometimes it's very easy to take a short-sighted view, but the broader real estate cycle, the broader economic cycle, and you really have to take a historic kind of view towards everything. So it's very easy to go back to 2008 and say, okay, this was a pivotal time in a economic cycle, the great financial crisis. When is this going to happen again? But you can't ignore, the 70s, the 80s, the late 90s, the 2000s. All of this swath of time is relevant, and real estate cycles don't only happen on a 20-year cycle. So there's broader pieces. And I think you so eloquently put, as you were kicking off this episode, the answer is these are all data points, and we don't know. No one really knows the answer. And something you tell me in our daily life that I think it always kind of sticks with me. I use it when I'm like coaching my team now. Is the goal is to use your big beautiful brain, right?
Yes.
Like, we're not going to tell you the answers. We're not going to tell you exactly what's going to happen because we really don't know. But what we do want to do is help you understand the way we look at things, if that's helpful as you're looking at your investment opportunities and what you want to put, where you want to put your money to work for you. Understand risk and really, like, the entire world, whether it's finance or any other segment, is very much kind of cause and effect. So if you see something happening in the bond market, there's going to be some effect from that. And really it's evaluating what you see on CNBC and using your brain to figure out what you think is going to happen, and then make your investment decisions trusting your own gut after you've done your research, you've listened to podcasts like this, you've listened to the talking heads on CNBC, you've listened to the Fed chair give his take, and you understand how everything works together to help make an informed decision on what you think is best going to happen. Because at the end of the day, the wrong decision, the only one holding the bag for making the wrong decision at the wrong time or not seeing things clearly is you. So I always feel like you have to captain your own ship, and you have to make those decisions with the research that you've done, feeling good that you truly believe in the investment thesis you put together for yourself.
Well, so I agree. And I think one of the things that we have to look at is the most recent history. So when we talk about how we got to where we are, obviously the biggest indicator for everything was COVID-19. And like, what shift did that create, right? So obviously it became an inflationary period. There was money printing that happened. There was tons of loss of jobs. There was also the fact that the supply chain was under, right? So like, let's talk about those kind of factors and how those have actually created the landscape we're currently sitting in.
Yeah, no, absolutely. And just briefly, the previous run up, and I think we don't have to focus on all the different historical relevance or the GFC, but coming into 2020 when COVID hit, you had a 10-year period where you were finally getting to the recovery moment where you're all the way recovered from what happened in 2008. And that is much different than the potential recession that we might have in 2025, 2026. So
right.
What is setting the stage for today is just like you said. The supply chain was massively damaged. We basically, as a country, told everyone, don't go to work. Lots of people lost all of their income. A lot of people were relying off of stimulus from the government.
Right.
The government did what they thought was best in order to keep the economy going. But at the end of the day, there's only so much money supply. So when you dump a bunch of new money supply in with what already exists, but you're not increasing productivity and real goods and services, you cause inflation. So was it a necessary evil? Yes. Could it have been done better? I think so. But we are where we are. We can't, those are non-controllables for us.
Right.
So now that we're looking out of COVID, supply chain has seemingly gotten better. All real prices for most assets have gone up, especially in real estate. Like you look at the single family home market, there's a lot of people that are sitting in cities where they can't believe how expensive some of the houses have gotten.
Absolutely.
I
think we're in one of them.
yeah. We're in, like, I spend my days in the multifamily market. Prices got way overheated and people were looking at the advantageous aspects of multifamily and saying, hedge against inflation, high inflation, let me dump my money in here. Created a really low cap rate environment, combine that with low interest rates, and you have property values kind of go through the roof, which was great for the momentum in the industry. But
let's talk a little bit about the stock market too, where we're at there.
And this is one of the things that I would caution people, because the stock market, I feel like, is in that same overheated area that multifamily was in 2021 and 2022.
Right.
So as you're looking to, like, you don't always want to put all your chips in one thing. You don't always want to, one thing you want to make sure you take advantage is when you're in something that's overheated, reallocate, reposition your portfolio, and take the second to ask yourself, is the stock market going to continue in a bull run, or do you think that there's going to be some kind of bear market? And
there's definitely a correction of some sort coming.
It's just inevitable that you're not going to have 50 years of a bull market. It's never happened, and it just can't happen, because what happens is people will put their money using, the same, we've covered this a lot on the show, but kind of fear and greed. I don't want to lose my money. I'm scared that if I continue all of my money in equities, I might run into some issues. If we get into a recession, where do people traditionally take their money from equities? They put it in real tangible assets like gold. Or now, a lot of people are looking at Bitcoin, which I don't claim to know a lot about Bitcoin. It's something that I am forcing myself to learn about, because the world is making people learn about this, because it's really, when the big institutional groups decide that they're going to allocate to it, you have to start taking it seriously as a commodity.
Absolutely.
But typically in a bear market, where your money is the safest is natural metals. It's in bonds, especially if you're getting the yields that you're getting today, and maybe reallocate to those types of areas. All tides rise when there's kind of high inflation and a really, really strong economy. I think what a lot of people that I listen to and value their opinion in the market, they're already reallocating to gold. So when you see a lot of the big, I won't call them doomsdayers, but really they're people that historically have called a lot of the down cycles. When you start hearing those people more prevalent, more people are taking them seriously. Everyone is now taking 10, 15, 20% of their portfolio and moving them into precious metals and, gold miners type stock equities where they're going to be able to take advantage if there's a run up on gold. Historically, in a bear market, that's a safe place to be.
Yeah.
So I think that supply chain's better. I think we all feel that. The economy seems to be, at least from the data points, fairly strong, which is causing the Fed to be patient. I don't think that that's a mistake. I think in hindsight, we might look back at it and say it's a mistake. I think that in 2008, when everything fell apart, you saw a very similar thing happen where inflation looked like it was getting out of control. We were coming out of a bear market. Property values were very high. Yeah. And you saw them cut rates and you saw a spike in the 10-year Treasury. And then almost instantly in 2009, the Fed's rate was at 0 because the bubble burst.
Right.
So you can't say that this is the exact same situation. There's lots of different dynamics that were relevant then that aren't relevant now, and vice versa.
But you can't say it's not going to happen.
You can't say it's not going to happen.
That uncertainty is
back
into play.
That's what, like, if in the way that I think about things, if that is a possibility, and when I look at the real estate market and I say, what's going to happen with all of these loans that are getting extended and pretended?
Right.
Like, that's a very real thing. And multifamily, it exists to a certain extent. But in retail and office, it's,
very prevalent.
Very prevalent. Like places that were 80, 90% occupied 4 or 5 years ago, or 40, 50% occupied, nobody wants the paper. It makes sense for the lenders to extend the loans, but there's going to be some kind of debt jubilee where eventually transactions have to happen and somebody has to put a new value on what these things are worth. And when that happens, a lot of the pretending in all of the markets kind of goes out the window, and that kind of creates a burst bubble. And when that happens, the Fed basically has carte blanche to lower interest rates and stimulate the economy. So
I want to ask you a couple questions. I think that I think that you've covered a lot here, and I want to make sure that I fully understand that we're breaking things down. So you just talked about a little bit about the 10-year Treasury. We talked a lot about inflation and interest rates. So what I'd like to break down is like the core, like why are we watching the 10-year Treasury, first of all, and like what is its correspondence to inflation and interest rates and that entire gamut, so that I know that I fully understand why this is so important.
Yeah, I don't want to get into an economics lesson, but the important parts that I think are relevant and I can simplify are you basically have a yield curve. And there's a short end of the yield curve and there's a long end of the yield curve. The short end of the yield curve is going to be your shorter term maturity. So 2-year, the federal funds rate. All of that is kind of on the short end because you're talking about the overnight trading rate and yield maturities that don't have a long duration. The long end of the yield curve is the 10-year Treasury and further. The reason it's important when you look at what the Fed's doing is I would make the argument that the Fed doesn't control interest rates. Okay. And what they can control and where they can make a big impact is the short end of the yield curve. But they don't really have the power to control the long end of the yield. And this is where the example that I would give is the lowest treasuries we've seen in the last year were in September of last year, where the 10-year was down, I think, into 3.8, 3.9. They hadn't cut any rates. And when they finally did cut rates, the 10-year went up 100 basis points to where we are today. I think today we're actually at 4.5, between 4.5 and 4.6%. But they've seemingly never had control of the long end or have lost control of the long end of the curve. Whereas logic would have told you that if they lowered the federal funds rate, that the 10-year should have come down. The 2-year did react pretty significantly, and there's more of a correlation to the 2-year to the federal funds rate than the long end of the curve. Now, the reason that this is important for everyday investors and everyday consumers is the yield that controls most of the things that affect you is the long end of the curve.
And why is that?
So the 10-year Treasury is what correlates and what lenders use for consumer product lines. So your credit cards, your car loans, your mortgage rates, all of those types of things will typically correlate to the 10-year Treasury yield.
Okay.
So if they can't control the long end of the curve, then they're not really in control of those products that are going to affect the consumer the most. And that is one of the reasons why I think that they're not going to continue cutting rates right now, because it's not also going to have the desired effect to stimulate the economy in the way that everyone would like it to. They could cut 50 basis points again, and the 10-year could continue rising. Because what does control the Treasury yields more than what the Fed does is the sentiment from corporations and individuals and people that are investing in treasuries and investing in the stock market and how the broader economy looks. And that's going to be based off of productivity and the earnings reports and the jobs reports and really how much everybody is spending and if they're employed.
That makes a ton of sense. So one of the things that I heard actually on a recent podcast, so this is not me saying this, I will just say, but I did hear this. And so take it for what you will, but I didn't even realize this was a thing, was that, in the last couple of years, our administration had been bolstering the jobs numbers by putting every month 30,000 jobs, federal jobs, into the market, which, I mean, a big giant loophole and a really great strategy to make our economy look great. But I never even would have thought of that, honestly. But the fact that any government, whoever's leading it, any administration can do that, to me, kind of makes me weary of, is this still happening? Is it not happening? Is the jobs report accurate? And I already know that there's already, they always change the numbers. They go back and it's all based off of statistics and surveys and whatnot. So my question to you is, do you feel like the jobs numbers that are coming out are accurate? To what point are they accurate? I just want to kind of know your thoughts on this.
Yes, I think generally the job reporting, they have a system. I don't think that we're talking about fraud or misrepresenting numbers.
I mean, maybe misrepresentation,
but
not fraud.
I think everyone should have a certain amount of skepticism
Yes.
when they look at anything. And I think that what I've learned in my entire life, but has really come to light over the last year or so and through the last several administrations, is one of the selling points for people that are blue-leaning or left-leaning is bigger government and more government spending.
Right.
So I have always kind of been somewhere in the middle on what I like. Obviously, government needs to exist. Obviously, government creates a bunch of value, but it needs to be more efficient, and it's usually not efficient enough. So I don't think that they said, oh man, we could make the economy look a lot stronger by hiring a bunch of people. Let's do that. I think that it was more of a symptom of which party was in office and what that party tends to do, which is kind of bloat government spending. And I mean, there's an argument to say that both parties typically do that. Right. I think what is happening right now with this administration, where it's almost a gutting of traditionally the way we think about government workers and the way we think about how the government is run from an efficiency standpoint, this is unprecedented. This type of deep dive into different sectors of the government and figuring out how we can make things more efficient, I think I think it's exciting. And I think it will make an impact.
It's definitely controversial, I'll tell you that. And I will say, I don't want this to be overly political by any sense of the imagination, but what I would like to go into is maybe more of we're talking about the market landscape. We're talking about how, what the cause and effects are. And so one of the uncertainty factors we talked about with the economists from CBRE, and John Chang as well, but the looming pending tariffs. We saw that they were being put in place and they were giving an extension. We've seen some come to light with China. Like there's just different things going on. There's a ton of dynamics happening right now with the brand new administration. But outside of let's take the politic piece away and let's just talk about the tariff piece. If those things happen, where do you see the marketplace and landscape going?
Well, and this is, I don't know if it's a hot take, but this is my personal belief. And, to bring back the political stuff back to the Treasury yields.
Yes.
I don't think Donald Trump has hidden the fact that he would like to see lower treasuries. He understands that for his administration to really show a strong economy, that eventually they're going to have to get back to lower treasuries.
Right.
He can't pick up the phone and call Jerome Powell. I mean, I don't think Jerome Powell, he very much feels like he doesn't answer to Donald Trump.
Right.
And I think that that's the way that the system is set up.
I think it's great.
But if you put me in Donald Trump's shoes and I'm like, my goal, let me figure out a strategy to get what I want. If my goal is to get lower treasuries, I know what does control Jerome Powell's actions, and that is the data that's coming out and the economy looking weaker than it is, jobs looking weaker than they are.
He's playing chess, not checkers. That's what you're saying.
This is my gut feeling. Like if I were him and I were
solely
focused on lowering treasury yields and trying to figure out how the person that's telling me no will not have a choice, it's getting rid of some of these government workers that were bolstering the job numbers and showing lesser job numbers. That's something he can control.
Right.
He can have less involvement in government spending. He can cut spending. And anytime that you cut spending, you're cutting productivity, and that is going to filter into all the data that Jerome Powell is forced to look at. And when that data comes in light and the economy, I think everyone should ask themselves that's watching this, do you feel like the economy looks strong from the data that's coming out? But do you feel like the economy is strong for you? Do you feel like your spending power is as good as it was the last time the economy was strong? Because I think most people would say this almost feels a little bit like a mirage.
I can tell you is we went to the grocery store yesterday and we came out with 2.5 bags and spent $81. And I was like, what's happening here?
Well, and that's the thing. So like if the reality of the situation is the economy looks strong, but the economy looks strong from financial engineering is the data is showing a strong economy, but people are truly hurting, worried about having a job, can't afford to buy groceries, can't afford to buy a house, can't afford to rent a house. If these things are all true, then maybe the answer is peeling back the curtain a little bit and showing a weaker economy so the treasuries reflect the true economy.
Right.
And I think that's probably closer to what I think is going to happen over the next, year or two.
Yeah, no, I completely agree with that. And I would say that I tend to believe that the general consensus is that everything is just too high. And I know that we all look at things and we say, man, this is so much higher than this year or that year, or whatever. And there's always going to be a new norm. Once this inflationary period happens, then it's set a new lower bar. But I think this bar is still a little bit too high. I really do. And I think that our new norm does need to come down a bit for everybody to not be in survival mode and be able to be in just like a living mode again. And I'm not even saying like an area where people can truly be like luxuriously living. I mean, just like not feeling the stress of surviving. And I think that we're seeing a lot of that right now.
Well, and what needs to catch up to the higher cost is higher wages, higher productivity, higher growth. Keep in mind that we're never going to see, most likely, I can't say never, but you're people expecting prices to go back to where they were in 2018 or 2019.
Not going to happen.
Not going to happen. You're not going to see deflation. They're trying to stop inflation.
Right.
So inflation is these prices getting worse. They're trying to slow down how quickly they get worse. Very rarely to never do you see prices regress. Like we're not going to see the prices we saw in the 70s and 80s when we talked to your grandfather and he talks about buying his first house for $10,000. Like not going to happen.
Right.
But what you can bet on is how quickly things are going to inflate.
Right.
And that's
and you and I just talked about that recently because I never really thought about deflation. I've always
some things will go down. Like now, where I'll caveat that is prices for homes and prices for real assets in 2010, there was deflation in the values because some of those values were propped up by people taking on loans that they couldn't afford.
Right.
And I don't think that we are in the same mess now, but the rampant inflation and the urge to buy multifamily and institutions playing a role in buying single family and building build to rent and participating in that market has created an inflation in housing that I think you could see prices significantly cut back because with higher interest rates, people just simply can't afford to buy at these prices. And those will balance out on basic supply and demand economics. If people aren't buying newly built homes, then developers will have to cut the price of those homes. And that is the biggest thing that I think everybody should always revert back to is supply and demand because it's the basis for true economics. So if there's a recession and people can't afford to pay for things, regardless of how inflated the price is, businesses will have to lower the price to meet the equilibrium of demand.
Yeah.
And that is where you might see some relief in prices.
I really hope so, honestly. I think that I don't want to see a recession, but I definitely think that we do need to see some pricing come down. And if everything keeps coming out so strong and they're just not going to make any changes, then the idea that that's going to happen anytime soon is just, it's a dream.
Yeah, and I think people get scared of the word recession. They definitely are scared of the word depression.
Yes. Oh, yes.
People love the term soft landing. Oh my God, I hear soft landing all the time. Oh, we're navigating the soft landing.
Yeah.
To me, soft landing means making the pain last longer. Like I think of a soft landing and I'm like, okay, there's this much pain that we're going to have. And if we're going to have a soft landing, we're going to stretch this much pain over this period of time.
Right.
In 2008, there was no soft landing.
No.
But by 2010, 2011, 2012, you saw things getting better. When you elongate, the pain's going to happen. The damage has been done. Right. There's nothing you can do to absolve yourself of the pain. The question is, how do you want that pain inflicted on you? Do you want it to be spread over a 15-year period where things are marginally good? Or do you want to accept your lumps for a bunch of money being printed and debt being at a very low level and figure out where things are overbought and overstressed and have that
create some neutral
critical chaos 1 to 2 year period and then start the next ramp up to the next bull market and get out of that bear market. That's when you'll see Treasury yields drop, when that climactic event finally happens.
So talking about like getting back to something like that, like the CPI data came out and they were showing that it was like hotter. Overheated basically. So give me your take on that. And
well, I mean, I think the CPI data and it has to be paid attention to because it's what the Fed is saying that they're
actually. Let's talk about, and for anyone who doesn't, what is CPI, just so everyone knows first.
Yeah, it's the Consumer Price Index, and essentially it is the engineered metric for which the Fed wants to look at inflation. So they'll basically pick and choose the things that they want to measure.
Okay.
And some folks might say there's some engineering to that. And then they're going to use CPI and PPI and look at it on the long-term trends and the short-term trends. Mm-hmm. And they're going to kind of gauge. And look, the way I feel is if they stick to it, they make a metric, and that's what they look at, it will be a useful metric. So even though I would poke holes in some of why I believe that that's a useful metric and a true measure of inflation, that's what we're given. So inflation's been sticky. And when someone says something's been sticky, it just means that it goes up, it goes down, it goes up, it goes down. I think if you look at the broader Treasury yields, and I was doing this with my number 2 at Viking, and he really tracks a lot of historical data because he trades stocks a lot. And we're going through it, and you could clearly tell that Treasuries, even though they're remaining sticky based off of the CPI data, there's a downtrend. Mm-hmm. And if you look at the tops and the bottoms of those charts, you can see that it's trending down. Okay. And I think that's a good sign. And the Fed's going to figure out what their neutral rate is eventually.
Right.
They're very, very coy about what they think it is. Now they're saying that we might be at neutral now. So my experience is that.
So, but what do you feel about the data coming out as overheated?
So what I would say is that yes, inflation is going to be sticky. It's less about the Treasury yields, and it's more about people aren't feeling enough pain and are buying less goods. The consumer hasn't realized that we're in a recession yet. Even though
that
I
was
would
actually going to
make
be
the
my next
argument
question for
that
you.
we have been and we already are in a recession, and it's been masked by this idea that we can have a soft landing. And I think one of the reasons why it's easy for the consumer to feel that way is a lot of people are able to leverage their buying power with credit and the ability to use credit.
So wait, we were kind of talking over each other. So what I was going to say was that would be my next question for you. So what you were saying is that you believe that we've actually already been in a recession and people really haven't seen it. So go on. They probably didn't hear you over me because I was like, no,
that's why I always say, like, ask yourself, how do you feel in the economy? Because the data of how you feel, your sentiment, what you feel, like, are you able to afford to travel as much? Are you able to buy whatever you want at the grocery store? Or are you getting to the point where you're like, maybe I don't need all of this. Maybe I can cut my budget. What if we do go into a full blown out, the world realizes we're in a recession? Like, maybe I should start cutting my budget now so I'm prepared either to take advantage of the opportunity of some kind of big cataclysmic event, or just so like I can survive.
I actually heard somebody today, it was very funny, on a podcast, and she said, all these people keep talking about like, well, I'm just waiting for the recession to hit and I'm going to take that opportunity. And she's like, oh yeah, do you have just like bags of money like sitting around? Because if you don't have literal liquidity and cash ready for that, then like, why is it that you think you're going to be able to? The big people will. And anyone who has like true liquidity like that and has a ton of cash lying around, 100%, that's going to be an opportune time for people. But if they don't have that, then like people are talking about like she's like, it's such a casual conversation these days because everyone's like, are we in one? Are we not? When is it going to hit? And I said to myself, I was thinking the same thing. I'm like, I think we actually might already be there a bit. And with like the quote soft landing that's happening, I think it's going to get worse before it gets better for sure.
Right. And I think it's everybody's perspective is going to be a little bit different.
Yeah.
So if you have a job that is less reliance on, like, if you're not selling something, so like if you're in retail or manufacturing, you'll see companies like, I think Walmart released their earnings today, way off where they thought. And that was like a big, topic today, is if Walmart's off, Walmart's a really good indicator of your average person in America. Because a lot of people, especially in a recession, they might just make the shift from shopping at Target to shopping at Walmart.
Right.
And when Walmart's off and people are spending less at Walmart, that's kind of a clue that things aren't as good as they seem. And that's the thing, is like, there are probably going to be a lot of people that are over levered in their own personal finances. So if you are carrying $20,000, $30,000, $40,000, or maybe someone might have $40,000 of personal credit available to them. Someone might only have one credit card with $5,000, but that being maxed out and them living paycheck to paycheck at a 27% interest rate, like they're waiting, and a lot of people, and I think if I had to guess, a lot of people are thinking things are probably going to get better. I can just use these to get by until things are better.
They're biding time.
And that's just not the way to use credit. Yeah. So I think that the personal consumer is hurting a lot more than the data is showing right now. And keep in mind that the data is always lagging. So what you see today isn't true of today. It's at least 30 days lagging. And in some cases, once you get the revisions, you're not getting accurate data for 90 days, almost a couple quarters. So
that's a really good point.
So it's one of those things where I personally feel like things are a little bit worse off than they seem, and people should plan accordingly.
Yeah. So that is actually going to lead me to my other question I had for you. So you and I, the reason we even decided to have this conversation today for the podcast is that, probably actually about a month ago now, you and I sat down and we were talking about what's going on in the economy, what to plan for. We like to be very much like where are we going to see opportunity? Let's plan our next investment. And we also like to say, okay, well, there's a lot of uncertainty going on. So what if my marketing job goes away? What if things change, or, people have to downsize? And everybody has to think that way. Everybody has to think. I mean, I didn't think that way before COVID. I didn't even know I could lose my job in an instant. I got a phone call, right? So I think maybe now people might be a little bit more sensitive to it and hopefully are planning, I hope, after everything that happened with COVID, and have a backup plan. But that is what really spurred this conversation. So if there were maybe, I don't know, 2 to 4 data points that you're looking at on a daily basis to help us when we're in our planning mode for our future and for our safety net, what are those data points?
Yeah, and I think that I would kind of break this down into 2 different directions, because I know a lot of the folks that listen to our podcast are real estate folks.
Okay.
And a lot of those folks are either active in real estate or they're passive in real estate. So,
But wait, outside of real estate, like before we get to that, because I do want to know more specifically to that, but as far as just like the general consumer person in the world who's planning, and you're looking at the market landscape right now.
what's my advice?
What are the 2 to 4 like data points that you're tracking, so that you know whether or not maybe we should be more bullish, or you and I should be like, okay, we need to like take a step back and like let's be in more of a savings mode?
Yeah, so I would look at the charting when it comes to the Dow and the S&P.
Okay.
And look for the highs and look for the lows and see if it's trending down. I would say that one of the things that scares me about Bitcoin is that I think that there's a correlation to Bitcoin's success and the S&P.
Okay.
So even though it's a commodity like gold and people are treating it as such, I think that if the S&P breaks and goes into a bear market, that I think there's going to be more correlation for Bitcoin and the S&P than people realize. And that's something that as I look at it as an investable asset, I'm trying to figure out how I truly feel about that. But that's something that I track and I'm trying to figure out daily. I think tracking single family, like real property that people actually live in, and less investable assets. So like what does it cost to buy a home? And if you're a young family starting out, you have a kid, you've been renting an apartment, you're trying to buy your first home purchase, what does that look like right now? And then over the next 6 to 12 months, as we see what happens with Treasury yields and we see what happens with the broader economy, how significantly do those prices drop? I think that could potentially be an opportunity, because I think that the higher end of single family is being propped up right now because the higher end of the economy is resilient.
They're
If
not
you make
feeling the pain yet.
$300,000, $400,000, $500,000 a year, and you're looking to buy a house in 2019 that was $800,000, going from $800,000 to $1.5 million, a little bit of a drop in the bucket. Like, you're still worried about how much money you have coming in, but you're saying like, I could afford property taxes that are $23,000 a year. I can afford a $7,500 interest or mortgage instead of a $4,500 mortgage. Like, this isn't going to break the bank for me, and I want that new house right now. Where I like to focus is the people that it's more of a need. They're trying to find out where they're going to live, and they're trying to make decisions on, do I need to buy a house that was built in the 80s? It's 1,800 square feet. Or can I buy that 2005 house that is the same square footage, but is going to cost me $3,000 a month in a mortgage? Or do I have to stay a renter? So like we track at Viking kind of rent growth. One of the things that we've noticed is that where rents have been flat or negative over the last few years because of how high inflation had gotten and things needed to correct, we're starting to see, even in our most challenged assets, significant lease trade outs, renewals, and rent
because
growth.
Because the affordability gap.
Rent growth is coming back because people aren't able to buy and they do have to rent. So those are the things that I track. And then when I do watch the news, I have a healthy amount of skepticism where I hear what people say, and then I want to do some research. I want to go around and see, people that have been in whatever asset class you're looking at. So like, for instance, if you're trying to learn about real estate, like listen to people like Willie Walker has a great podcast. He has Peter Linneman on there. He has really great folks that really have been through multiple market cycles, have been, the head of Wharton Business School, their real estate division. He like helped set that up and run through that. Like those types of people that are really showing you the correlation between what happened in the 70s and 80s. Like one thing that no one really talks about is the idea of stagflation, where you have no productivity and high inflation. That's like literally the worst case scenario. And I don't know that we're headed there, but I've heard people make that argument.
Mm-hmm.
It's like really spend the time to understand all of the optionality and then kind of geek out over it and figure out what you think. And then, once you feel like you know what you think, then start looking for opportunities based off of what you think is going to happen.
Is there a specific, obviously Google, but is there any specific platform or like specific website that you usually go to when you're looking for like historical pieces?
I feel like and maybe I come from a family of researchers. Everyone in my family has always had, and it's been taught to us by our parents, kind of a thirst for knowledge. So I don't like just go to one site and say, this is where the information comes from.
Yeah.
I want to look at everything. I want to look at the people I think are smart. I want to look at the people I think are dumb. I want to know what everybody's saying. And then I want to come up with my own decision.
But what about like historical facts? Is there anywhere you specifically go, or you just like Google search a specific thing?
So when I'm looking for historical trends, usually the barometer for whether I think somebody knows whether what they're talking about is if they actually went through, if somebody was working in a role where they went through the 2008 financial crisis and they have a real experience that they felt, I think the information, the data that they're giving could be useful. I'm still going to analyze it and not just take it at face value, but I want to see people that lived through the 70s and 80s and had real estate roles in the 70s and 80s and can actually give me, because in my opinion, you can learn a lot by studying and researching, but the real lessons are learned by going through it. That's why when you're looking for someone to invest with and they say, we've been doing this for 40 years, you're like, wow, they've seen some like really hard times and they're still around. They've gotten through it. Those are the people that I seek out and I say, hey, like, what was it like for you? Like you started a company in 2007 and in 2008, this happened and it didn't tank your whole company. You made it through. Like what are the things that helped get you through that? Yeah. What did you tell your investors when it looked like you lost all their money in 2 years and you were able to build trust and then believe in you to get through the next 20 years and create a fortune? That's who I seek out.
Yeah, that makes total sense. So to wrap things up, I have one last question for you. And it's going back to kind of what you were mentioning is you are our real estate expert, right? Like you are the VP of Investor Relations at Viking. You've had a pretty substantial history in real estate, both commercial real estate, both in the multifamily as well as on the like hospitality hotel side of things. Like you've had a vast array of experience. And so one of the things that I know that maybe people who are looking for opportunities right now would like to know is, with the current market landscape, do you see anything that is showing you opportunity for whether you're an active or a passive real estate investor?
Yeah, I do. So I'll do active first, because I feel like this is an area where we personally spend time researching and looking. So I think that there is going to be some deflationary pressure on real property. So I think over like track that and look in your area. Like if you're thinking about buying a duplex or you're thinking about buying a rental single family home and you want to park capital and you don't really want to be passive, you want to be able to maintain it, track those trends in your area and look at how severely prices are getting cut, because there's many people that don't have a choice in whether they sell or not. And that's where I really like, there's divorces, there's deaths. Like our neighbor passed away.
Yeah.
And really
when
unfortunate.
The jobs take you away.
Her estate, she didn't have a lot of family. Her estate is now in charge of selling this house and it's going to go on the market. And there's no option to not sell. It's going to sit there and somebody's going to make an offer and they're going to get an opportunity probably, because somebody doesn't get to just say, well, I'm going to wait until times are better.
Right.
Seek out those opportunities. I'm certainly looking for them personally. I would say when it comes to looking at your broader portfolio, most people that are active in real estate also have exposure in traditional equities. this might be the time to rebalance your portfolio, take some of your winnings away from a historic bull run in the Dow and the S&P and reallocate to some alternatives, reallocate to precious metals. I think that's a really strong play. On the passive side, and you can kind of see my thought process play out through what Viking's doing, we're focused on basis. And I think that's just generally the real estate model that has been proven over time. But when you're looking at deals, when you're looking at working with sponsors, focus on protection when it comes to DSCR and being able to create a floor where if you're losing anything, you're not losing your principal. And know that if you're able to get the best basis and that's where you're focused, that you're going to be protected and be able to weather any type of recession that we hit. Now, if you're worried about inflation, active or passive, put your money into rental housing, because rental housing is going to fare well in inflation, but do it intelligently to where you're making sure you're getting it at a good basis. I would say don't chase yield, because a lot of places are going to show you strong yield. This is something that I have to talk with investors all the time and let them know that when you invest $100,000 or $500 million, like the most important thing of your investment isn't that 4.5% return, because sometimes getting that return is masking, if you bought at a really high basis, the overall return. We're always focused on making sure that we're protecting principal. We're risk managers at heart, and we want to engineer the best outcome, even if that means the yield isn't there. Not everyone's going to present investment opportunities that way, and some people are going to really be attracted by the yield, even if it means that their long-term gains are at risk. And that's something I'd protect yourself against when it comes to passive.
Well, I really appreciate all of your insights. I feel like this was a really great conversation. Tons of actionable items that people can use. Definitely, for me, it helps me when we talk about all of this, and then I feel more comfortable about where our future is, and just to kind of understand like where your mind is when we talk about the intricacies of the marketplace and what's going on in the day-to-day. I mean, I feel like every single day news comes out, reports come out, and it kind of actually stresses me out a little bit. So knowing that you have such an incredible like hold on what's going on is like reassuring. But I'm sure for the listeners, thank you guys for joining us. And I hope that truly that Chris was able to give you guys some like actionable insights. And we really thank you for joining us again. Please like us and follow for more. Have a great rest of your day. Thank you for tuning into this episode. We truly appreciate your support. Don't forget to subscribe, leave us a review, and share the podcast with your friends. Until next time.